Hello everyone and welcome to Study IQ English. I'm Joycey Joy. Today we'll be discussing about NBFC sector in India, non-banking financial institutions. Let's get into it. First, coming to the eligibility conditions regarding registration, supervision, the capital requirement, etc. So first is regarding the registration. The NBFCs are registered under the Companies Act. Remember, banks are also registered under the Companies Act. So same way, NBFCs, they are also registered under the Companies Act. So they come under the Companies Act. This is very important. Now, regarding the supervision, who supervises the NBFC sector in India? It depends. Like if they deal with mutual funds, then it is supervised by SEBI. The mutual funds category of NBFCs are dealt by SEBI. If they deal with insurance products, they are supervised by IRDAI, and some NBFCs who are registered with the RBI, they are overlooked or supervised by the RBI as well. So the supervision depends on what kind of products they deal with and what is the kind of registration that they have. Next is the entry capital. What is the minimum capital requirement for an NBFC, non-banking financial company? So for a micro-financial company, 5 crore is the minimum capital requirement. And for others, 2 crore is the minimum capital requirement. And 200 crore for reissuer. Next is the number. That is how many NBFCs are there in total, the registered number of NBFCs. In total, there are 10,190 NBFCs. Out of this, only 108 NBFCs are deposit-taking NBFCs. And apart from that, all the rest are non-deposit-taking NBFCs. Now, whether the NBFCs can accept deposits or not. Now, we have seen that 108 NBFCs in India are deposit-taking NBFCs. So, only those deposit-taking NBFCs can accept deposits. They can accept deposits but also only time deposits. It cannot be savings deposits or current deposits, but it can only be time deposits, that is fixed deposits. That is the NBFCs which are registered as NBFC deposit taking, they can accept deposits, but that also only the time deposits, not the current or savings deposits. Deposits are not insured under the DICGC. This is very important. What is DICGC? DICGC provides guarantee or insurance to the deposits of the customers. Now, if you are depositing some money in a bank, in a financial institution, in a bank, DICGC will provide a security or an insurance in case there is a collapse of the bank. And this is up to 5 lakh rupees. Earlier it was 1 lakh, but now it has been expanded to 5 lakh rupees. Up to 5 lakh rupees of your deposits are insured under the DICGC. So this is only applicable to banks. NBFCs are not covered under this, which means that the deposits you keep with the NBFCs, the time deposits, are not insured under the DICGC. Can they issue checkbook, credit card or debit card? No. 3 of this cannot be issued by NBFCs. They cannot issue a checkbook or they cannot issue a credit card, also a debit card. Coming to the prudential norms, SLR is applicable but only on NBFCs which are deposit taking. So, SLR, statutory liquidity ratio, is applicable. What is a statutory liquidity ratio? Statutory liquidity ratio is the percentage of deposits that the banks have to keep with themselves to meet their liquidity requirements. So, SLR or statutory liquidity requirements are applicable on those NBFCs which are deposit taking. And the percentage of SLR is decided by the RBI. RBI can prescribe different slabs or formula for the SLR of these NBFCs. CRR is not applicable on any type of NBFC. This is also very important. All these points are very important from your prelims perspective. CRR is not applicable on any type of NBFCs. Whether it is deposit taking or non-deposit taking, CRR or the cash reserve ratio is not applicable. Coming to Basal capital adequacy norms, the Basal norms, they are applicable on 108 NBFCs which are deposit taking. Again, these are also applicable on about 276 non-deposit taking NBFCs, but here the condition is that these NBFCs are systemically important with assets of more than 500 crore. So Basel capital adequacy norms, Basel norms, these are definitely applicable on those NBFCs that are deposit taking. But those NBFCs which are not deposit taking, it is applicable on those NBFCs where the assets are more than 500 crore and those NBFCs are systemically important. If an NBFC is considered to be systemically important, it means that it's too big to fall or fail. Why? Because when they are called as systemically important, anything happening to this NBFCs, or in case if they fail, it can affect the entire system, and that's why they are given a extra protection. So here they are systemically important with assets over 500 crore. So it is also applicable to non-deposit taking NBFCs as well if they are systemically important. So don't get confused with that. Now regarding the investment, the NBFCs cannot invest the money from their clients or the customers in the share market. Okay, they cannot invest the client's money in share market. And regarding the loan interest of the loans given by the NBFC, it varies and depends on the type of business. There is no fixed interest rate. It depends on the type of business. Regarding the recovery of loans, the housing finance companies, that is NBFCs which come under the category of housing finance companies, they have options for recovery under the SARFAESI Act. This is important. So SARFAESI Act is not just important for the banks but also for the NBFC sector, which falls under the category of housing finance companies. The customers' complaints can be dealt by the Ombudsman. So RBI, the Reserve Bank of India, has a separate Ombudsman for the NBFC sector, and this Ombudsman will be responsible for handling the customer complaints. Now, coming to NBFC regulated by the RBI. Invest and credit companies. These are the different types of NBFCs that are regulated by RBI. First is Invest and Credit Company. SREI is an example of such company. Second is Consumer Durable Loan Finance or BNPL, like Bajaj Finance, FlexPay, SPay, etc., which gives loans for customer durables, consumer durable. Now, like for example, if you want to buy a car, if you want to buy a scooter or a television or a fridge, Bajaj Finance or such kind of finance, NBFCs provide you loans. So that is again regulated by RBI. Next is Core Investment Company, like the ILNFS, Tata Capital, Reliance Capital, etc. Core Investment Company, which gives loans for investment projects, long-term loans for investment projects. They are also regulated by RBI. Next is Infrastructure Finance Company, Infrastructure Debt Fund. Examples are L&T, then IDF, IDFC, etc. So these are also regulated by the RBI. Next is Asset Reconstruction Company, ARC. Asset Reconstruction Company, which will help the banks to reconstruct the loans. Example, Anil Ambani's Reliance. So all these help in asset reconstruction. It comes under the supervision of RBI. The factoring companies, like the Siemens Factoring, IFCI Factoring, etc., again comes under this. Gold loan companies, Muthoot Gold Loan, Manappuram Gold Loan, Gold Loan. There are NBFCs which give loans to customers on the basis of gold as a collateral. Microfinance institutions like the Bandhan, Ujjwan, Kashpur, etc. also comes under the regulation of RBI. Next is Mudra, that is a refinance agency. Fintech, P2P lenders like the Credmint, Fairsend, etc. Fintech companies, account aggregators, then fintech companies, loan aggregators. All these fintech comes under the regulation of RBI, and residuaries also comes under the regulation of RBI. Now these are the NBFCs regulated by the SEBI, Securities and Exchange Board of India, and it depends on what kind of products the NBFCs deal with. So stock brokers, NBFCs who act as stock brokers like the Motilal Oswal, etc., they come under the regulation of SEBI. Next is mutual funds, NBFCs dealing with mutual funds. Then rates and InvITs. Rates is real estate investment companies, and then InvITs investment companies. So this also comes under SEBI. Investment banks, merchant banking companies also come under SEBI. Venture capital fund, VCF, it also comes under SEBI. Next is NBFC regulated by others. So these are the other agencies that regulate some other kind of NBFC. IRDAI is Insurance Regulatory and Development Authority of India. This IRDAI regulates those NBFCs which deals in insurance products. Then PFRDA, Provident Fund Regulatory and Development Authority, that deals with Provident Fund. National Housing Bank, NHB. There is Ministry of Corporate Affairs that deals with some NBFCs. Then State Registrar of Chit Funds. So these are some of the other regulatory bodies that regulate the other kinds of NBFCs. Now this is a question that is asked in Prelims 2010 with regard to NBFCs. Question is, with reference to non-banking financial companies, NBFCs in India, consider the following statements. They cannot engage in acquisition of securities issued by the government. They cannot accept demand deposits like the savings deposits. So these are the two statements. We have already discussed both these points in the class. So you have to work it out on your own and find out the answer. So options are 1 only, 2 only, both 1 and 2, and neither 1 or 2. So go through the question one more time. Try to get the answer and put it in your comment section. Thank you so much for watching. I'll meet you again with the next video. Thank you, and I wish you all the very best.